Thank you so much for joining me today on the Market Pulse. Al, we'll start with you. What are the drivers causing uptick in the metals markets at the moment?
In the last 18 months, it's really the AI buzz that we've seen around the world and the demand that that's generating in terms of data center build out as the market realizes that the power needs for that build out are substantial and will involve electrification across grids, grid infrastructure spend, has particularly benefited copper initially, which is part of that electrification process. Also, the chips that are built out in the AI sector has particularly benefited the likes of tin, with solar demand as we try and spread our power across renewable energy sources. That's benefited the likes of silver as well as tin. But more recently, obviously, that power drive has really seen a pickup in interest in Ali, as we realise that not only have we got to harvest that power, but we also have to transmit it to various regions. You've seen that in China, but you're seeing that manifest itself in other parts of the world. Aluminium being such a high power usage in terms of its production levels.
Yeah, it's interesting. It's leading to in aluminium specifically. It's a real fight for power now. And recently, I think a couple of weeks ago, or even this week, a mothballed aluminium smelter in Kentucky was sold not to another producer to produce aluminium, even though the price of aluminium inclusive of the Midwest premium is well over $5,000 a ton. It's been sold to a company called TeraWulf, which is going to turn it into a data center site and use the 750-acre site, but also use the power infrastructure that already exists there. So I think there's certainly a bullish narratives on the back of the AI and now the data center story for different reasons, and it's certainly affecting copper, aluminium, and tin, as Al alluded to.
And I guess the uncertainty around tariffs, as well as some of the geopolitical events that are unfolding, are also causing some disruptions to physical flows. Is that correct?
Most certainly. In the last year or so, we've certainly seen it impact copper, for example, and that draw of metal to the USA. Robert Friedland talking about it today, saying that the market incorrectly thinking that there's a 1 million ton of stock sitting worldwide, which is elevated, its highest it's been in decades for this time of year. But also going on to say that he doesn't see the US government allowing that metal to leave. Although it's not part of any US government strategic fund, the fact is that if it becomes open and that they can ship it to other parts of the world, he does not see that as likely that the US government will make moves to prevent that from occurring. But
Yeah.
you've seen that draw of metal to the US.
Yeah, 100%. And I think the soundbite from the US administration was time for copper to come home, and that was sort of early last year. And the speculation was the tariffs were going to come in. They started a 232 investigation into copper specifically, and the critical mineral or the critical resource it is. It's the second biggest metal consumed by the defense industry in the States. So it's obviously very important to them. And when they say it's time to come home, then I guess they don't want to let it go now. There's over 500,000 tons of stock on the COMEX, and there's rumored to be 200,000 to 300,000 tons off warrant. So there's somewhere around 800,000 tons of copper in the US. They've achieved what they wanted to achieve in many ways. Copper has come home, if that's what they meant, and it will be a surprise if they just let it all walk back out of the country.
And in the same manner, since the Liberation Day sell-off,
Yeah.
on the first announcement by the US administration of a tariff policy back in April 2025, on that move down below 8,500, you did see Chinese reserve buying, whether that was State Grid or State Reserve Bureau. It was part of that Chinese government machination taking on stock, which they want to accumulate because they want to nearshore for their industry going in the years ahead, particularly ahead of their 15th five-year plan, with a Chinese NPC meeting early March, at which point that plan and the plans that they have for that economic 5-year outlook will be laid out.
Yeah, certainly very interesting time, and that draw of copper to the States has made the rest of the world is relatively short of copper. Going forward, obviously the story's deferred. In the here and now, there's plenty of copper around the world, be it onshore in China or in onshore in the States, as we said. But and it's not, the time isn't quite now. It is a deferred story
On copper, yes,
on
indeed.
copper, yeah. But
and that's why the interest really has turned more to aluminium in the last few months, particularly, which is seen as having a tighter situation because you have had the likes of Mosal smelter in Mozambique, which had an offtake agreement with South 32, but which has not been able to secure the power agreement that
Yeah.
makes it feasible for them to produce aluminium. Big supplier to Europe.
Yeah.
European supplies have been really impacted. You saw that during the Ukraine, the first incursion into Ukraine in the early 20s. The fact that geographical pools has big impacts on our commodity prices.
Yeah, the regionalisation of sort of commodities, the step back from globalisation, the amount of the value of the commodity made up by regional premiums now is sort of growing in itself, but also the volatility is growing an awful lot. You know, that we've seen different premiums for copper or ali really move around. Obviously, some of it's driven by the tariffs in the States, but other than that, you know, the tariffs, the premiums are moving all the time, and it's becoming a real factor for us all.
Indeed, we have many clients who often ask us the impact on prices and particularly the underlying, for example, aluminium, if sanctions, for example, are implemented. And the reality, as Paddy says, is that the impact is actually on the premiums generally rather than the underlying. Of course, it will have some impact and it's positive, but it's the premiums initially that sees the big reaction.
Yeah.
Paddy, you've obviously been with us for 19 years on the floor. Have you seen a difference in the types of investments from investors recently as well?
Yeah, for sure. It's always a changing landscape. You know, 20 years is quite a long time anyway. But having joined around the financial crisis and everything that followed that, and we've seen, you know, different types of investment or money drive the market at different times. Obviously, we had quantitative easing after the financial crisis, and that drove money into the markets. But then more recently, obviously post COVID, we had the sell-offs and the real trap length in the markets when we had that sort of black swan event, if you want to call it that, which meant all the consumers were trapped long of metal they couldn't do anything with. They couldn't make cars anymore. They couldn't do it. Everything was shut down. And then we had that flow of money when things started to reopen, and China sort of bought a lot of things on the lows and then carried on buying. But latterly, it's been this investment by central banks into things like precious that have really changed the dynamics of the market. So in 2024 and 2025, you know, the Polish government, the Indian government, the Chinese government, and others, they all bought physical gold. Kazakhstan, and you've got some thoughts on why they bought those hard assets.
Well, we saw central banks buy approximately by the end of November almost 400 tons of gold last year, which again, when we looked at our data last April, because our data, Marex proprietary data, positioning wise, looks at the spec flows, our data didn't actually reflect the vast sums of money that was coming in from central banks. Of course, this is essentially a reaction to high government debt. You know, when you look at the USA in the last 25 years, they've accumulated 30 trillion in government debt. So you're essentially got a country which is paying more to service that government debt than it is on military spend. When you think about the USA and its military abilities, it's quite staggering. But essentially, it's a fear of that. It's a divestment from currencies. Obviously, the dollar, amid this geopolitical turmoil, gets a lot of the headlines. But the reality is, it's a divestment from sovereign FX and towards hard assets. And that's why gold and silver benefit initially, but we have now benefited in an arena which is too small to handle that volume of money coming in, particularly when you consider the vast desert of money that, you know, we have had no money interest in our space or commodities as a wider asset class for a number of years because it's once bitten, twice shy, so to speak. But what you have now is you have that investor money coming in. And of course, the world is much more high frequency.
Yes.
So we live in a world that reacts much more quickly. By the time this is published, many more things will have no doubt occurred, whether that's a walk back on tariffs, whether that's a 15, 20% implementation on everybody. But the reality is, outside that fast frequency world, we've seen wider money coming back into our space. And that's what's really driven But also from China, it's that retail flow,
Yeah.
which has been absent over the last 3 to 4 weeks as the Chinese authorities tried to curb that speculative excess, tried to protect those retail clients who've already, bear in mind, been burnt by the Chinese property crisis that they continue to face, which has hurt most of the households there who've had interest in second homes and the such like. But that retail money has exited. Risk has largely reduced. So now what's going to be really interesting is with China back on the 24th, Shanghai reopening on the 24th of February, over the next 2-3 weeks, and around that MPC meeting early March, it's going to be really interesting to see how their underhedged consumer behaves, particularly given the destocking environment that we've seen reflected in those big stock inflows that we've seen on the likes of copper over the last 2-3
Yeah,
months.
sure. I think it's interesting. The ETF flows on precious metals are somewhere north of 700 billion. That is the estimate in terms of holdings of gold and silver in the ETFs, or money in the ETFs, and they're not all physically backed. The majority are. So
Not
yeah,
so much in base metals though.
base metals is harder to it's harder to trade in that respect. If you want to get exposure to the copper price, for example, the ETFs are sort of few and far between. Hasn't really filtered through into the base space yet. People still tend to trade equities if they want exposure to the copper price.
Which is why the Rios and the BHPs have really benefited.
Sure. So we're somewhere in a bit of a state of flux, really. And while 700 billion sounds an awful lot of money, and it is, there's 200 trillion invested around the world in all asset classes. So it's still a very small amount, yet for the size of precious metals markets, which are quite big, it's still enough to really change things at the front end of and in the physical markets. So,
and what's key about this investor flow is it comes at a time post a higher interest rate market, post all the global uncertainty that we've experienced particularly in the last 5 to 6 years, is the fact that you've got an underhedged consumer. And also, aside from the geopolitical and the economic, changes in relationships and the nearshoring, people wanting to protect that supply, is the fact that you have an underhedged consumer coming at a time when you've also got people deciding to invest in our space.
yeah,
Yeah.
and that's certainly providing a floor in the short term in copper. If we just carry on talking about copper and aluminium, which we are, if the consumer hasn't bought forward, then he or she has more to buy at spot.
And that's something you've described to me so aptly historically about Ali, that it's not just about price, but it's also about timing. And what we're saying now with the demise of companies, merchants like Mikey in China, where you've seen this centralization of economic power, etc., is the fact that copper is now become more about time as well as price, hasn't it?
Yeah, 100%. The consumer, whether you're buying copper to use to create copper foil to use in a phone, or you're buying copper to turn it into copper wire, and for the reasons that we've already discussed. You don't want to pay $13,000 for it. You don't want to pay $12,000 for it. But the reality is, you're out of time. You have a commitment to buy the copper. It's just unpriced today. So that's the kind of pricing that we're seeing on the dips, whether it's copper or aluminium. If it's the forward producer in Ali is now in cash. He's at the front end of the curve, and we're seeing something similar in copper, which means that the sell-offs are less aggressive. The distressed sellers are in less distress on the dips, and the consumers there to sort of stop the market falling for now. Now that can all change, obviously, but certainly for the last month or two, that's been the theme.
And we see that progressing through first Q and into the second Q, I would suggest, and it's going to be the second half where we think there'll be big road bumps that the markets will have to face. But certainly in terms of copper and Ali, Ali's floor has been risen. Whether it's 3,000 or 2,900, it's certainly a lot higher than the 2,600 floor we saw in 2025.
Yeah.
And then on copper, we've seen trade express interest in buying copper from 12,500, when a lot of trade clients were muddied and confused by the move above 11,000. So we're essentially on an escalator, a rising floor, which currently continues to go higher.
Yeah, and I think the interesting change in dynamic is this sort of this whole army of private investors around the world that's since COVID trained themselves to trade things like Bitcoin. So
Mm.
Yeah.
you have these avid investors that really want to trade something, and they weren't that interested by things like copper because there wasn't enough volatility in it. Bitcoin's moving
Sure.
10% a day, copper's moving 10% in a year, and then you have to pay away the contango, so you negligible gains. So suddenly, when gold and silver and copper are really moving around now, Bitcoin's going the other way. It's only a matter of time before more of these investors, these sort of retail investors, come for our space and try and get exposure to these prices that actually do provide some kind of hedge for their lives, whether it's copper or cobalt or aluminium or gas, all these things. So it'd be interesting to see how that plays out and how that investor is able to get exposure to these prices.
And that exposure, that sort of participation, we talk about governments, trying to gain reserves. Then you think about trade houses. So some of the big energy firms that have now moved into the metals space amid that energy transition. And then you think about the retail, high frequency trading. At Marex, we're very much used to dealing with systematic traders. But going into conversations with clients where historically one would be asked about what's your outlook, what do you think in the market? The reality is nowadays it's your speed of execution and your ability to cover your client base 24/7 and provide them with a professional execution and management service, essentially.
Yeah, and as the volatility grows, that's going to become more and more important. So
Yeah.
certainly
That
something we pride ourselves on.
that actually leads to my kind of like last question, which is, we've spoken a lot about all the different moving parts. Where are we going from here? What are we saying to clients or counterparties who are trying to navigate this?
The way we've just described the world, forecasting longer term, comes with a poisoned chalice at
Yeah.
times.
Yeah, for sure. But it's hard. The macro is not terrible. The micro is
Agreed.
interesting, if not, but it may be deferred. And if the retail investor comes into our space, then it certainly looks interesting and certainly going to be volatile.
We certainly have a soft micro backdrop. That is, stocks have built on the likes of copper. There was a downstream buyers strike in China. They didn't like the higher price. They have to get used to it. But over the next month, it's going to be key to see those stocks start to shift. That's inventory, that China comes back and that we see a pickup in their demand. But likewise, people underestimate India at their peril. Our own Ian Roper, who does our S&D research, looking at Indian demand on Alliand copper, and even if it sounds unexciting at a 1% incremental demand pull from that region, you're basically looking at a country that's just agreed to spend 133 billion on infrastructure spend. You are looking at, as I said earlier on, you're looking at a number of different factors fighting for those metal supplies all at the same time. So over the next few months, particularly given the money flow, we think that metals have the potential, perhaps not to break through on copper to new highs, because that 14,500 peak looked like an exhaustive move, as did silver. And we know historically, from a technical point of view, it's often difficult to take those out. But the bull story is still there. It's not going away. And we therefore think that over the next few months that certainly from a money point of view, and the expression of that in the options market lately has seen the first signs, green shoots of money coming back into our space, having liquidated after that very volatile session into the end of January, early February.
Yeah, and I think if you want to see signs of the micro improving, it will be in the data somewhere. It'll be in stock draws or other key indicators. So I think that should lead into the timing. Whether it's, a few months is possibly a bit short because there is a lot of stock to work through, but it's a deferred story. But how deferred? Don't know.
There remains uncertainty, tariff uncertainty from weekend events, Iranian Straits of Hormuz uncertainty. That obviously impacts the oil markets greater than us, because we've discussed on particularly the likes of aluminium, how actually shipments of Ali through that part of the world have actually diminished and have actually now being shipped around other strategic maritime routes, aren't they?
Yeah, and the markets don't like uncertainty, as we know. So I think most friendly to volatility going forward. And the LME and the CME have very, very deep pools of volatility, although it moves. So with the options trading, is certainly going to be very important if you want to represent something for a medium-term view.
Great. Thank you both so much for your insights. It's been really interesting.
Not at all. Great pleasure.
Thank
Great.
you.
Thank you.
For those interested in more of our insights, Alastair shares regular commentary on the global Marex Metals Neon channel. You can also find in-depth market analytics from Dr. Guy Wolf on his channel, including speculative positioning estimates, risk premium analysis, nanalytics insights, detailed spread reports, and more. Links to both will be in the caption above. In our next episode, we'll be diving more into precious metals markets, and we will be joined by Ben Bush, Senior Metals Market Maker, and Paddy Seymour again. We look forward to seeing you again.